All right, welcome to The Explainer. Today we're going to dig into a really fascinating puzzle in finance, this surprising link between risk, return, and companies that are strapped for cash.
So here's our game plan. We'll start with the puzzle itself, then see how a clever model tries to solve it. We'll look at its big idea, make a really crucial distinction, and then see what it all means for how we think about debt.
So first up, let's get right into the mystery that had researchers scratching their heads when they looked at these cash-strapped firms.
I mean, the basic question is, should you invest in companies that are having trouble funding their own projects? You could probably argue it either way, right? But when people actually looked at the data, the answer was, well, it was a total mess.
And check this out. This is what's so interesting. You had one major study in 2001 that found these firms earned lower returns. But then, just a few years later, another big study comes out and finds the complete opposite. They said they earned higher returns. So what gives? This contradiction really set the stage for a new model to try and figure it all out.
So how do you solve a puzzle like that? Well, the paper we're looking at tackles this by building its own economic model. You can think of it like a little laboratory where they can isolate what's really going on.
And the key innovation here, the real genius of the model, is this idea called the shadow price of new debt. It's a theoretical way to measure just how badly a company needs one more dollar of funding. The best way to think of it is like a pressure gauge. The higher the reading, the more desperate that company is for cash.
Okay, so you've got this pressure gauge. The next big question is, how does that pressure translate into actual investment risk? And the model points to this one core idea it calls the inflexibility mechanism.
And there's a fantastic analogy for this. Think of the economy as a really bumpy road. A healthy company, one that's not constrained, has great suspension. It hits a bump, say a recession, and it can use its cash to invest and just absorb that shock. The ride for shareholders stays smooth. But a cash-strapped firm, it has terrible, stiff suspension. When it hits that same bump, it can't afford to do anything, so the whole car gets violently shaken around. That bumpy, volatile ride is the risk, and it's a risk that investors want to get paid for.
Now hang on, before we go any further, we have to make a really important distinction. Being financially constrained is not the same thing as being financially distressed. People mix these up all the time.
And look, the researchers who first studied this were crystal clear about it. They said constraints just means there are roadblocks preventing a firm from funding all of its good ideas. It's about missing out on growth, not about going bankrupt tomorrow.
So let's just break it down side by side. A constrained firm has great ideas but not enough cash. It's a missed opportunity story. A distressed firm, on the other hand, can't even pay its current bills. That's a risk of default story. Totally different things. The companies we're talking about are in that first bucket.
Okay, so what does all this mean for the bigger picture? Well, this whole inflexibility idea actually forces us to rethink one of the most classic concepts in all of finance: corporate leverage, debt.
The standard theory, the one you learn in Finance 101, is pretty simple. It says that as a company takes on more debt, its stock risk just goes up in a nice straight line. It kind of assumes the riskiness of the company's actual business doesn't change. But this model says, hang on, not so fast. It argues that risk doesn't just go up in a straight line, it actually curves upward, accelerating. And why? Because taking on more debt makes a firm more constrained, more inflexible. That stiffens the suspension, which makes its underlying business even riskier. It's not just a straight line, it's a curve that gets steeper and steeper.
This all brings up a huge practical question. The shadow price is a great idea for a model, but you can't just look it up on a Bloomberg terminal. So how do analysts in the real world even try to measure this stuff?
Well, they have a couple of go-to tools. The two most common are the Kaplan-Zenglis, or KZ index, and the Weighted Wu, or WW index. Basically, these just combine a bunch of public data, like cash flow, debt, dividends, to create a single score that's supposed to be a proxy for how constrained a company is.
So the paper does something really clever. It uses its model to run a horse race. It pits these real-world indexes against its own true measure, the shadow price. And it finds that, yeah, they're pointing in the right direction. They are positively correlated. But they're not explaining very much of the actual story. And here's the absolute kicker. The best performing index, the one that does the best job, is capturing less than 12% of what's really going on inside the model. That means almost 90% of this inflexibility risk is basically invisible if you're just using these standard tools.
And that leaves us with a pretty provocative question to end on.
This model has just uncovered a type of risk that's not only very real, but it's also measured incredibly poorly by the tools we all use. So it really makes you wonder, if we're missing almost 90% of the picture on this issue, what other hidden risks are out there, quietly driving the market every single day?